From Wall Street to managing hundreds of millions in client money, Nick and I use our alphabet soup of credentials to discuss the investing and tax strategies that actually work. Oh, and we played Division I college football together, so strap in. This one hits hard. Let's go.
Alrighty, folks, we're going to try to cover a lot in about 30 minutes. Number one, we're going to cover the 4 ways. Yes, there are only 4 ways the U.S. can get out of $40 trillion in debt. We're also going to talk about President Trump doing 1,000 trades last month. Yes, folks, that's 1,000 trades in a month. Is that insider trading or is it just some tax harvesting? We're also going to talk about, Trump's at it again. He's demanding that the Fed cut. And then finally, we're going to talk about something called price disparity, something that might be an early sign of pain to come. Taylor, what's going on, man? How you doing?
We got a lot going on here. It's interesting. The doldrums of summer have brought about a lot of news this year. And I feel like the last few Augusts actually have come with some wild things playing out in the market and market volatility pops. Not that we're seeing a pop right now, but last year, the year before, it was massive swings in the market in August.
Well, something we may cover at the end of this is obviously we also are in a trade war with Canada now. Shocking. We're back to doing those stupid things. And also we have Jackson Hole on Friday. So if we have time, we'll get into both of those topics. But let's get to the first one. $40 trillion in debt. People are talking about it's running away. The bond vigilantes are coming. I thought we should just step back and walk through the only 4 ways we can pay this off. And you did an excellent reel on Instagram for this. So why don't we talk about the 4 ways and, kind of dig in and we'll get on to the next topic.
Yeah, I think that we'll order these from most optimistic to least optimistic from a country output standpoint. So the first one is the one that the politicians in DC are running with. And that's, kind of a run it hot. We'll grow our way out of this. And so their policies are attuned with getting the economy to run as fast as we can, to have tax receipts grow as the economy continues to boom. And as tax receipts grow, you have this diminishment of the overall debt because taxes are coming in higher. That's your revenue side of things. And that's optimistic to think that we're going to climb our way out of $40 trillion worth of debt because we have just absolute runaway growth in the overall economy. So, I mean, that might be a little bit of folly. We can get some of that, but that's not going to make up for all of it by any stretch.
Well, I mean, at some point, we just need to bend the freaking curve, right? This thing is going parabolic. And, Bessent went in with Trump talking about the 3-3-3, one of those threes being 3% GDP growth. And near as I can tell, we're not anywhere close to that currently.
Well, not even that. Also, he talked about a 3% budget deficit, which we're running at 6.7 right now. So we're not even directionally moving the right direction there either. Bessent, it's funny, man. Bessent, everyone loved him out of the gates. And I think that his popularity is diminishing very rapidly with some of these things that he's doing. He talked about, terming out debt and being longer term in nature. And now we're buying long-term debt. We're going to have to issue short-term debt in order to do so. And so he's just replaying kind of the Yellen playbook that he said he was getting away from. Anyway, I won't go down that rabbit hole too far. Way number 2 is to cut. So cut expenses. And cut expenses is often kind of the social kind of programs that we have. And the reality there is, yes, that brings your expense side of the equation down. Your balance sheet of your expenses comes in. The real risk to cutting is that then without the social programs, you aren't paying typically the lower half of the K that then is going out and spending to maintain tax receipts where they are. And so all of a sudden now you cut your spending, but you also cut your revenue because tax receipts drop because people can't afford to go out and buy things anymore because you're not giving them the money to do so.
Yeah. And David Freeberg, of the All In podcast, has been on this for quite a while. He's spent a lot of time in DC with Trump's victory, and he's really become disheartened, right? Politicians, he says that politicians' job is just to get more money for their set of people, and nobody is serious about cutting expenses. So number 2 does not seem likely. It's mathematically correct, but it ain't happening.
You can't get in office. You can't get in office.
You certainly can't stay in office.
No. So the third is the most realistic, and that's just the fact that we pay it down with a less valuable currency. Just inflate your way out of it. It's the only way to get anywhere near $40 trillion. It's just such a large number. It's such a seismic number. You can't have growth of the economy that's that rapid to increase tax receipts that much. You can't cut $40 trillion worth of spending without bombing out the economy on the bottom end. And the reality is it's inflate or it's number 4. And number 4 is just utter chaos. And that's the US throws their hands up and says, hey, we can't afford this. We default on our debt, and people don't understand how interconnected the entirety of the world is. And that would cause utter global economic chaos.
Yeah. Yeah. Default really doesn't seem to be an option. But let's go back to inflation. Because again, one would argue we've had inflation, for 4 years now, roughly above trend, maybe 4 years, 48 months. And even with that, we're up $6 trillion in 4 years, something like that on the budget. So
it's bananas in the fact that, like, listen, you run a 6 to 7% budget deficit when you're in the depths of a recession.
Yeah, exactly.
You don't run a 6 to 7% budget deficit when you are at 4.5% unemployment or wherever thereabouts that we are right now. That's a short unemployment line. You don't need the spending to go out and juice the economy to get it back rolling again. The economy's rolling right now. Why are we spending so much money? And the reality is, it's a two-party system politically. And so if one side says, hey, we're going to increase taxes and pay for social programs, well, that's a net neutral, and we're still running 6 to 7% budget deficits. And the other one is we're going to cut taxes, and tax receipts are going to go up on the other end because the economy is going to run so hot. So both parties are promising to maintain spending where it is, which is a problem.
Right. Yeah. And the other thing I think about, back to number 1, right, the kind of grow your way out of this. I've never met a government official who wouldn't just find new ways to spend money. Right? They're just going to create another program. Oh, we got an extra, $100 billion. Let's just spend it. We don't need to pay down the debt.
Yeah. And if it's the Democrats, it's going to be that. And if it's the Republicans, they're going to say, we'll just lower taxes further. Right. And it's two ways to the same endpoint.
So default is the ugly, scary, cataclysmic, depression, scary outcome of all of this. But doesn't that increase in likelihood the bigger this number gets? Like
it does. It does.
50 trillion.
The reality is
trillion,
we just
70.
We're just kicking the can further and further and further. If we continue to run 6 to 7% budget deficits, there's no way that number ever comes down, right? And if you're running a 6 to 7% budget deficit and inflation is at 3%, right? There's a gap there of 4%, right? And so that's the increased real rate of debt that we're putting on our balance sheet. A 4% increase when the economy is running very, very well, right? And I'm not, this isn't an economic, are we in good shape or are we in bad shape? This is we're not in an extreme shape, which is the policy that we have at hand right now from a spending perspective.
Yeah, we're not negative 2% GDP in the depths of a
correct.
recession.
And what happens if that happens?
Yeah, dude. It is getting wild to me. And again, I'm curious. We'll jump to this topic. Lots of noise, chatter, talking. Ray Dalio, the last 72 hours, basically said Scott Bessent's latest attempt to push the long end down is a sign that he's about to lose control. And he told people to go buy gold and Bitcoin. Do you see that?
I did not see that Ray Dalio went out and said buy Bitcoin, but look at Bitcoin. So it was funny. Bitcoin was dead in the water at 60, 60, 60, 60, 60, 64, 62, 58, wherever it was. And then this is what Bitcoin does. You don't know when it's going to happen. It's dead money for a period of time. It's dead money as it came down from 125 to 60. And then boom, it's an explosive asset class. And as soon as the uproar of our debt's getting out of control got loud enough, it erupted higher. And then also there's Trump really trying to push through this Clarity Act as well, which is also something that now is overwhelming the negative side of the equation, which was that Bitcoin is software and software can be hacked. And AI has proven that several times, even from these cold wallets, these extremely safe places that people store Bitcoin have been unlocked and the money's been removed and there's no retribution for any of that. So that was the negative, but the positive outweighed it, at least in the short term now, where I think it's at 78K up from 62 in the last week or week and a half.
Shoot, last 3 days. I mean,
there you go.
Not even 10 days. Yeah, it's pretty crazy. Well, let's switch gears. We'll talk about President Trump doing 1,000 trades last month just to stay even. You could also throw on the opposite side Ro Khanna Rokana did a couple of thousand trades. I'm going to guess it's the same shenanigans going on behind the scenes. But why don't you educate people what you think is likely happening? And maybe it's not the scary headline that people think it might be.
Yeah, I think that everyone sees that and they're like, hey, this is insider trading. Well, like reality is 1,000 trades in a month. You can't have enough insider information to try to pull off 1,000 underlying trades and be profitable.
Yeah, if you were doing insider trading, you do 5 or 6 trades. You would not do 1,000 trades.
In size. Yeah. So there's only one logical explanation as to what's playing out here. And it's called long short tax loss harvesting. So a very, very popularized strategy over the past 10 years is something called direct indexing. And so I'll use that as my launching point into what long short tax loss harvesting is, because long short tax loss harvesting is more of that on steroids, and it is much more effective in getting into the end destination. So the goal of all of them is to capture losses. And capture losses, sounds like a negative thing, but it's not. It's capture losses so you can offset a future gain. So direct indexing is take the S&P 500, but don't buy the ETF, buy an individual stocks. So you buy all 500 underlying individual stocks.
So boom, that's 500 trades right there.
Yep, you're hoping for them to go up in value, but inevitably stocks are going to go up and down along the way. And there are going to be periods of time where Google sells off and you have the ability to sell Google, capture that loss, and then repurchase it 31 days later after the wash sale goes away. And then you start to bank up these losses. And then down the road, if you have a gain selling a property for your space or selling a business, which is oftentimes what we do for folks, this is a way to offset that. Now, the detriment to direct indexing is that you're long all of these stocks. And over time, stocks go up. So in the first year or two, there may be some things that tick to losses and you capture that loss and kind of move forward. But essentially, the portfolio becomes stale and nothing winds up changing because over a 3-year period, every stock in the portfolio is up.
Got it.
And so it becomes static. So the iteration then changed and they said, okay, well, what if we were to go long and short simultaneously? So now you've got 500 or so stocks that you're long of, 500 or so stocks that you're short of. Now, to be clear, from a tax rule perspective, you can't be long and short the same position. That's not allowed.
That's a no-no.
But you might, they're going to try to retain similar positions on the long side and the short side. So you might be
like long lows up on Home Depot.
Exactly right. Exactly right. And so directionally, they're going to trade together. So if the market, broadly speaking, is going up, your longs are making money. And so you're holding that. Your shorts are losing money. And they're going to very rapidly sell that short book in order to garner the losses, right? If the market moves the opposite way, obviously your shorts are making money, your longs are losing money, and kind of washing the underlying performance net neutral, basically. But you're garnering this piggy bank of losses that then at some point in the future can be used to offset a gain. And I'll add one more point of confusion to this. So think about that as kind of bucket one and bucket two.
Yeah.
Those buckets are actually sourced from leverage that's going to be placed on something like the S&P. So if you give them $100, they're going to put the S&P $100 to work in that. And then they're going to use leverage to put that long and short on. So effectively, the performance is going to be directionally what the S&P 500 does in that long and short extension, which is what they call it, is there as a sidecar for the most part to drive those losses.
Got it.
But it creates a very highly turned over portfolio because the market's always going up or always going down. So there's always a loss to be grabbed somewhere. And so that's the explanation as to how someone could have 1,000 trades in a single month.
And also not be involved 1 second.
Correct. None of this is out of his discretion. And actually, these are more algorithmically traded than they are anything else. Bang, 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 bang. I mean, you get 1,000 trades in a month. Yeah, you have to.
That'd be hard. That'd be hard to do with a keyboard. Yeah, exactly.
That's exactly right.
Yeah. So again, that's what's likely happening with President Trump. Also, Rokana, just to take somebody from both sides, likely the same thing happening. Let's talk about it didn't take that long. It took about 100 days for President Trump to start demanding rate cuts from Kevin Warsh. He is being relatively kind. He's still calling him my guy. He's still talking about the board is, political. So he's not yet throwing Warsh under the bus, but he wants rate cuts. What do you think?
I think that there's almost 0% chance that we get a rate hike or cut in September. More likely, right, is the rate hike, at least by the probabilities. Right now, I think it's showing a 40% chance, a 60% chance they hold pat, 0% chance they get a rate cut.
Yeah,
Zero.
there's no rate cut coming.
The inflation's just far ahead of target, not moving in the right direction, at least demonstrably not moving in the right direction. And therefore, bang, they're dead in the water. I believe your argument still sits on they're gonna raise because
I am more convinced than ever that they're raising.
And you give me the points. I won't regurgitate your points that you have on this. I thought they were educated and smart. You spoke them last week.
Yeah, I think there's a couple of things going on. So first and foremost, kind of the one that's kind of nuanced is the calendar. Yep. I think if they had their ways, they might give it another month to wait, but then there's October, and the October Fed meeting is about 2 weeks before the election, and there's no chance they'll raise in October. 0 chance they raise in October. So I don't think they want to wait till December. So that's the nuanced, calendar force my hand thing.
Yep.
But the second one is it was a 9-3 vote last meeting. The Fed minutes, if you read them, which I did, really made it sound like there were more than 3 ready to dissent. Right? It sounded like 4 or 5 would have not been unreasonable if they really would have voted their consciousness. And since then, I've counted 6. Now, not all of them are voting, but I've counted 6 Fed presidents that are ready to raise. So, and then the last thing is, dude, we've had inflation so high for so long. And oh, by the way, if you just want to throw in another wrinkle that we got yesterday, we're now in a trade war with Canada, our second largest trading partner. And if you don't think that's going to be inflationary, you're a freaking idiot. Yeah. So at some point, the Fed's going to be like, I got to save my reputation. This is not going away. The last thing I'll say, just because I'm a data geek, the base effect is not helpful for CPI this month. It's essentially replacing a 0. So CPI is going to look to the newbie like it's rising again.
Right.
So, dude, I don't think they have a choice. September's a given.
So counter to that,
please.
You're under the opinion, and it's incredibly likely. I'm under the opinion, and more so in this camp now than I even was last week, that it's incredibly unlikely.
Perfect.
Because of the moves that Bessent has recently pulled. Mm-hmm. So Bessent now says, listen, long end rates are getting away from us.
Yes.
And so I'm going to pull 2 moves. So we'll start on the first one. That's kind of the easier, more straightforward one. He said, listen, we're going to use money to buy the long end of the bond curve. And that should bring down interest rates on the long end of the curve. Well, now, mind you, it hasn't been that effective yet, to be clear.
Yeah.
But
yeah, about 24 hours, Taylor. 24 hours. That's how long that lasted.
Exactly. But to be clear, like, you have to remember, like, okay, that sounds logical. More buyers on the long end of the curve, more competition should drive interest rates down where the Fed doesn't have to pay, or the Treasury doesn't have to pay quite as much.
Yep.
Reality is, reminder, we're in $40 trillion of debt, so we don't have that money. And so we're going to have to rob Peter to pay Paul. And what I mean by that is we're going to have to issue short-term bonds in order to source the capital to buy the long-term bonds. So the Fed controls the short end of the curve. And if the Fed raises rates, short end interest rates, or how much the Treasury is going to have to pay buyers of short-term bonds is going to increase.
I would argue
making the debt problem worse.
I would argue it's already up. You know this. The 2-year leads the Fed, or at least it historically did. The 2-year is already up, saying, hey, you idiots, you're behind the curve. The other thing I just want to throw at you, and you brought this up on one of your great Instagram reels, and I'm going to wonder if the reverse is true. And I actually think it is. What do I mean by that? The last 3 times the Fed cut rates, the long end went up. Mortgage rates went up.
Right. Well, we're talking about the short end. Well,
no,
my point is on the short end.
No,
and I agree with you that does lead the Fed. But if the Fed raises, the bond market has to price in higher, the short end of the bond curve has to price in the higher likelihood that interest rates are going to perpetuate further higher on the front end.
Right. So again, let me finish I don't know this one. This is just like, hey, I wonder if this is going to happen. So again, they cut 3 times, the long end goes up. Mm-hmm. I wonder if they raise, if the long end falls. Because now, chances of a recession go up, cost of capital goes up, the AI trade blows up. Hey, if you really want the long end down, maybe you need a rate cut or rate hike.
I just don't think they can afford to. because the
Okay.
front end cost of capital is going to be more expensive then. And that's where they have a more direct impact when they
Sure.
move interest rates.
Very true. Very true.
And then,
All right.
and then my second point falls on the Bank of Japan.
Oh,
And
yeah.
so the Bank of Japan, the yen starts to unwind, their interest rates go higher on the long end, which creates more competition
Sell
for buying in the
treasuries.
US. Then Besson says, okay, well, we'll backstop you so you don't have to cash in your treasuries to buy your own bonds and keep interest rates down. We'll buy the yen in the bond and force long end rates on your end lower so there's no competition for buying of our US treasury. And I know there's a lot there, but
Yeah.
just understand that. Okay, so then the Bank of Japan announces 2 days after the Fed announces in September. So it's September 16th and then September 18th is the Bank of Japan. If we raise interest rates, well, let me give you the context for the Bank of Japan. The Bank of Japan 3 weeks ago had a 25% chance of an interest rate increase. Now they have an 86% chance after we pulled our little stunt there. And so now we know they're going, or at least it looks incredibly likely that they go. If we go, all of a sudden that's a net neutral move.
Right.
And so that is another headwind against us raising interest rates.
Yeah. So I love the fact that we're on different sides of this because, again, one of us will be right, the other one will have a learning lesson, which is really cool. Yeah, I don't see how they keep their keep the faith of people around them if they don't raise. So let's talk about Jackson Hole. That's important. That's this Friday, 11 a.m. Eastern, 8 o'clock Pacific. Maybe it's 10. But either way, do you have any expectations what he won't talk about Friday?
Yeah. So I think this is his setup where he likely talks tough. And I think the market probably responds. And so he talks tough as a hawk that higher interest rates might come, or, whatever very guarded language he uses that the market can try to peel through and start to understand something, which again has been impossible for the market thus far. I think that the intention is the takeaway from the audience should be, yes, there's a chance, and then it doesn't happen. So I think you probably get a reprieve potentially based on the hawkish tone, and then I think it doesn't come.
The Friday reaction, because the market's open, is going to be rates go higher.
I think so. I think the market won't digest
and then
that
pull
well.
back. Yeah.
Yeah.
Okay.
Yeah.
So
but again, like to reiterate, and you got this, but then they don't go.
Right. Exactly. Yeah. They set the table, and then they don't do anything. Yeah, I got that. I want one thing from Kevin Warsh on Friday. And if he doesn't do this, I expect the market to throw up. He has to define inflation. He has to give us a target. Right now, telling us what inflation is not helpful. Like, what is it? Is it PCE core? Is it mean trimmed? Is it some other wonky thing? Because unless we have a target, we have no faith that they're doing anything. Mm-hmm. So my hope is he defines inflation. What do you think?
I don't think he does.
Oh.
I don't see any inclination to him to be any more forthright than he's been. Candidly, like that is his
At
MO,
some point, the market's going to put his feet to the fire, though. You can't do that as a Fed chair.
You're not wrong. You're not wrong. And the other reality is, like, give us something on what your task force are doing.
Yeah.
Something.
Do you think he does
right
anything?
now
He has a
you're passing the buck.
Does he have an early reading of task force on Friday? Too soon?
He doesn't want to say anything. He doesn't want to say anything. And that is so juxtaposed. Is that the right word? Whatever.
Yeah.
That is so the opposite of everything that the market's been used to now for 40 years.
Yeah. Yeah. All right. Again, Friday is going to be our conversation. Next week is going to be fire because that'll be after Jackson Hole. I'm sure we're going to have lots.
Who's right? Who's wrong?
No, I just think it's going to be wild because it'll be market. Friday will be market moving. That much.
It has been, and the market knows that it has been for the past several years. And right now, this is the closest to a coin toss that we've had going into Jackson Hole for, is the Fed going to raise? Are they going to cut? Are they going to, like, they're not going to cut, but are they going to raise, or are they going to stay on hold there? This is the closest it's been to a coin toss. So that leaves more variability in the market to try to figure out what is going to happen from that point and start to price it accordingly.
Yeah. Well, let's we're gonna close with price disparity because that's an interesting one that I want to talk on. But I'm going to insert a new topic here. And we just went to trade war with Canada.
Mhm.
Is this something you think is just going to taco away and not going to become a problem, or do you think we're really going to start doing another trade war this time with one of our closest neighbors?
I have learned, and I think everybody has learned, to take everything that comes out of DC right now as a negotiation that don't pay it too much mind. So I don't think there's any huge impact that comes from this. I don't think there's any huge impact to uh, Iran is going to have death and despair on their country because the economic sanctions that we place on them, et cetera. I think these are all bargaining chips. Trump
Mhm.
is moving around pawns, and Bessent's moving around pawns and trying to get the reaction that they're looking for to bring them closer to a deal that's in
Okay.
favor of the United States marginally versus whatever they're currently being proposed. This is my take.
Yeah. All right. Well, let's close on price disparity because, again, I think you put out an amazing reel on Instagram kind of highlighting this, and we can just use NVIDIA as an example. So define price disparity and then tell us what you're seeing in the market.
Yeah. So price disparity is something, and this was interesting because this was just covered in a Barron's article, and Barron's is one of the sources that I think does a really good job of trying to stay down the middle and not be overly bearish, not be overly bullish at any time, and just really report facts, right? They and the Wall Street Journal are probably 1 and 2 or 2 and 1, whichever way you want to look at it, as best financial publications in the world. And so one of the things that doesn't get tracked very often is price disparity. And so what we're talking about with price disparity is taking a look at the Wall Street analysts. So these are the quote unquote experts, and them forecasting going forward where the prices of underlying stocks or indices like the S&P 500 will wind up. And what happens is when price disparity is low, then the market really feels that they have a bead on where things are going. And that typically leads to better outcomes. And that's just a function of looking at data and looking in the rearview mirror and saying, okay, a year ago, was price disparity wide or was it narrow? The more narrow it is, the better the returns out of the market have been.
Got it.
Right now, price disparity is very abnormally wide. And
Ginormous.
enormously wide. So like
Yeah.
I'll talk to the S&P and then we'll draw more kind of functional hands-on numbers around NVIDIA, which I think is a good context point. So anytime price disparity by the analysts is north of 30, that's when you start to raise a red flag. Right now we're at 63 on the S&P 500. And I know that probably means nothing, but I want to make the context that it's not just NVIDIA, the example that
It's
I'm
the
about
whole
to give
thing.
you.
Yeah. Yeah. Okay.
So NVIDIA's share price today is somewhere around 220. I don't know what it is at this morning,
yeah,
but
call it
it's
220. Yeah.
okay. Yeah. So it's right there. So on the low water mark, the lowest analyst has it at 172, which is, not
Down
terribly down
20%.
from where it is, but
yeah.
down. Yeah.
Yeah.
The highest analyst forecast is 720,
Up 300%.
up 300%. Right. And so you look at this and like in the video, I said, listen, layman's terms, this is utilizing the same spread of numbers. This is like having a realtor come to your house and say, hey, we'll sell your house. And you have two of them come. One says it's worth 500K. The other one says it's worth 2 million.
Yeah.
That's the disparity there. And so if you look at just this year, the companies with the widest price disparity from analysts, they are down 16% year to date.
Interesting.
The ones with the tightest price disparity are plus 10%. And so you can see there, even this year, long term, those numbers stand firm, and that is the directional. Now it's different year to year, but nonetheless, less price disparity means more see-through clarity, and typically means the company's in a healthier position. And what's taking place right now, and why disparity is so darn wide, is just because people don't know what to make of AI. And that's driving the market. So some people say, listen, AI is going to be, the next greatest thing, and it's going to drive all this productivity, and the insatiable demand is not going to stop, and you can perpetuate that for 5+ years into the future, and therefore NVIDIA deserves a $720 price target. Other people think we're in an AI bubble on the other side, and that this thing is going to come cratering down, and therefore their price targets are so much lower.
Well, it's so again, I hadn't planned to go here, but again, I saw another one of your reels and you were echoing something you and I've talked about, I think on the record, but maybe privately, that China is, I think, going to purposely try to hurt the US right where we're vulnerable, which is AI, by dumping their open source models when we have closed source models, taking revenue down. I don't know if you saw this, but OpenAI's revenue last quarter up 18%. And let's just say that is not a high growth number. And you're not going to keep that valuation. And it is rumored that that number was so bad, the CRO, Chief Revenue Officer, left. CFO left, and they're delaying their IPO.
There is a talent exodus out of OpenAI. One, I mean, so it's OpenAI and it's Anthropic. Like those are the two. They're runaway favorites. They are the ones that are changing the market, et cetera. Anthropic, and we've spoken about this ad nauseum on this. Just the fact that Anthropic went after corporate, NVIDIA went after, or I'm sorry, OpenAI and ChatGPT went after the consumer. And both of them have crazy ass CEOs. Like, both of them. And
I call them Bond villains. That's what I think they are. I think they're Bond villains.
Their job villains is what they think that their job is. They literally come out and they're like, hey, we're gonna start, crushing white collar
dumbass
employment in the United States. It's like, shut up. Like, even if that is your thought, why would anyone want to hear that out of your mouth if you're trying to sell a product into the market, especially to the corporate
especially the consumers. I mean,
workers work for, right? Yeah. So,
well, it's funny. Sorry to interrupt. I actually talked about this on my daily financial news. This just tells you how to touch Darius, the CEO of Anthropic. He said this: the U.S. AI backlash is a crisis of trust, not a messaging problem. I said, you have your orders of operations wrong, you dumbass. If you come out and tell everybody 50% of the jobs are going away, that's not a crisis of trust. That's a messaging problem. This guy's an idiot.
These guys are folks that are, you got to think about the person that's in the role, right? They built this coding entity and they're nerds, right? And they're used to working in back offices, not being spokesmen for a, Fortune 500 company that goes to, New York City every day and puts on a press conference and all that. They don't. And so they talk the way they think. And it's like, they needed a PR. They still need a PR training lesson, because at the end of the day, you can't come out and say to people like, we're going to whack all these jobs. Like you're an idiot. Who's going to want, and then you go out and you start utilizing all these books that are copyrighted to train your models, which is illegal.
Yeah.
And now you're openly admitting that. And then Sam Altman on the other side comes out and laughs off the fact that his chat models are now hacking into companies, and they think it's funny or a marketing ad for them, for the power of their underlying models to be able to break through security and go in and manipulate these underlying companies. Like, it's a good thing. You're a moron.
Yeah. Not good. Not good. No, these guys, they're just Bond villains to me. That's all they are. They're just this generation's Bond villain. So anyways, this is always fun. Always love having these conversations. Again, I still don't know how you do 5 minutes of value in a 60-second clip. Tell people where they can find it.
Yeah. Thanks so much, Michael. It's always a pleasure coming on here. You're well read, you're well informed, you're well spoken. So, my pleasure for coming on your show. Thank you for always having me. Yeah. So find us at Life Goal Investments. That's our handle. We're on Instagram. We're on TikTok. We're on YouTube. We're on LinkedIn. We're on all of them.
There you go, folks. And if you don't know who Life Goal Investments are, they deal with the top 1% of the 1%. We are very lucky to have the CEO each and every week. Taylor, you're amazing. Thank you so much.
Thanks so much, brother. We'll talk next. Quick ask. If you're enjoying the show, hit the follow and drop a rating. It helps more folks find our podcast. Thanks so much.
The information discussed in this video is for educational purposes only and should not be considered investment, tax, or financial advice. Investing involves risk, including possible loss of principal. Always consult a qualified financial professional before making any investment decisions. Past performance is not indicative of future results.